Hey everyone, welcome back to Corporate Decoder, the place where we pull back the curtain on the world of business, and today we're diving into Bollinger Innovations Incorporated's latest filing, which is packed with some interesting financial moves that could really shake things up. Now this is your typical quarterly check. In it is a Form 8K, which means something significant and immediate has happened. And in this case, it is all about a pretty substantial securities purchase agreement that was signed on September 18th, 2025. This agreement is essentially a deal where an investor is putting a significant amount of money into Bollinger Innovations. Let's unpack what this means. Bollinger Innovations entered into this agreement with an investor to sell them convertible notes and warrants. Think of convertible notes as loans that can be turned into company stock, and warrants are like options giving the holder the right to buy stock at a certain price in the future. This deal is worth about $4.1 million. What is particularly interesting is that a portion of this money, about $368,000, was already effectively purchased back on August 27th, 2025, and another $1.6 million was purchased on September 4th, 2025. This shows a phased approach to this funding round, and it is set up so this investor can actually buy even more notes and warrants up to another $4.1 million. This is contingent on a registration statement for these securities being declared effective by the SEC, and the company getting stockholder approval. This gives the investor a long-term commitment to potentially fund the company further. Now here is a critical point. Bollinger Innovations has agreed not to issue or sell any new equity or similar securities for a specific period. This is called the restricted period, and it lasts for 90 days after a few conditions are met, including the SEC declaring a registration statement effective and getting stockholder approval. This is to protect the investor's position and prevent the dilution of their investment before their securities can be properly registered and traded. They also have what is called an exchange cap. This means the investor can only convert their notes or exercise their warrants if it does not result in them owning more than 9.9% of Bollinger Innovations' existing stock. Furthermore, the total number of shares issued from these conversions cannot exceed 19.9% of the total shares outstanding unless they get explicit stockholder approval. This is a common way companies manage ownership percentages and comply with stock exchange rules. Bollinger Innovations has committed to holding a stockholder meeting within 40 days of this agreement to get that crucial approval. Let us get down to the nitty-gritty of these notes. They carry a 15% annual interest rate, and they come with a 5% original issue discount. That discount means the investor is effectively buying the note for less than its face value, which is an incentive for them. These notes mature in just 4 months. And to make sure the investor gets paid, the company has granted them a security interest in all of its assets. So the company's assets are essentially collateral for this debt. The key feature here is how these notes can be converted into common stock. The conversion price is based on a few factors. It is the lower of a set price like $12.50 for one note, or 95% of the stock's closing price. On the day a registration statement becomes effective, or 95% of the average price over the 5 days leading up to the conversion. Importantly, the conversion price won't go below a certain minimum value even if the stock price drops significantly. It is not subject to adjustment. Different notes purchased at different times have different conversion prices reflecting different market conditions at the time of their issuance. What happens if things go wrong? Well, if there is an event of default, the interest rate on the notes automatically jumps to 20%, and there are some quite specific events of default listed here. These include failing to get stockholder approval within 40 days, not having enough authorized shares to cover potential conversions, delays in delivering shares after conversion, and even defaults on other significant company debts or major judgments against the company. It paints a picture of what the company is agreeing to and what could trigger harsher terms. Along with the notes, the investor also receives warrants. These are good for 5 years, and they allow the holder to buy company stock. They can be exercised using a cashless method. This means instead of paying cash to buy the stock, the holder receives shares equal to the value of the warrant after subtracting the exercise price. The formula for this is based on the number of shares the warrant is for, the value of the warrant calculated using a complex Black-Scholes model, which takes into account factors like stock price, volatility, and time to expiration, and the closing bid price of the stock. Interestingly, Bollinger Innovations has the right to force the warrant holder to exercise their warrants for cash if certain conditions are met. Primarily, this happens if a registration statement for the shares is effective and the company's stock price is at least 250% above the warrant exercise price over a 10-day period. This benefits the company by bringing in cash directly. Bollinger Innovations is required to reserve a significant amount of stock, up to 250% of what could be issued from these notes and warrants. This is to ensure they can meet their obligations. If they fail to deliver shares on time, they face penalties. These penalties can be severe, including paying 5% of the value of the undelivered shares daily or buying back shares on the open market if the investor had to purchase them elsewhere due to the company delay. They are also required to make adjustments to conversion and exercise prices for things like stock splits or dilutive issuances to protect the value for the warrant and note holders. They've actually put in a formula to adjust the conversion and exercise prices if the company issues stock at a lower price than the current conversion or exercise price. This is designed to protect the investor from their investment being devalued by subsequent lower price stock sales. The formula essentially recalculates the price based on the number of shares involved in the new issuance. Beyond the purchase agreement, there is also a registration rights agreement. This is crucial. It means Bollinger Innovations has to file a registration statement with the SEC to allow these purchased securities and the underlying stock to be resolved by the investor. They have strict deadlines for filing and for getting that registration statement declared effective by the SEC. Failure to meet these deadlines comes with significant financial penalties that can accrue over time. These penalties are essentially a form of compensation to the investor for the inability to sell their shares freely. The filing also states that these notes and warrants are being issued under an exemption from registration requirements of the Securities Act. This exemption, specifically Section CA, is for transactions that do not involve a public offering. This means the investor is considered a sophisticated investor. Now, this is a major operational change. On September 19, 2025, Bollinger Innovations filed an amendment to its charter to enact a 1 for 250 reverse stock split. This is a huge change. Essentially, for every 250 shares of common stock that existed before, they are now 1 share. This took effect September 22nd, 2025. The company went from over 126 million shares outstanding down to just over 506,000. This is often done to boost the per share price and meet exchange listing requirements like staying above $1 on the Nasdaq. The trading symbol BIN remains the same, but there is a new CUSIP number for the stock. The company also notes that conversion and exercise prices for outstanding notes, warrants, and other convertible securities will be adjusted accordingly to reflect this reverse split. Fractional shares won't be issued. Instead, any fractional shares resulting from the split will be rounded up to the next whole share. The company also issued a press release on September 18th, 2025, specifically about this reverse stock split. This is important because it means they are disclosing this information to the public in a way that complies with fair disclosure regulations. Now let's talk about what this all means. Bollinger Innovations is clearly in a phase where it needs capital, and it is securing it through debt that can convert into equity. The significant reverse stock split suggests the company was likely struggling with a very low share price that could have put its Nasdaq listing at risk. By consolidating shares, it aims to increase the per share price. The investor, by taking on convertible debt, is betting that Bollinger Innovations will succeed, and its stock price will rise significantly, making their conversion or the cash out of their warrants profitable. The heavy penalties for failing to register the shares or deliver them on time show the investor is well protected and expects timely execution from the company. The company's ability to manage these obligations, especially obtaining stockholder approval and completing the necessary SEC filings, will be critical in the coming months. The success of this strategy hinges on the company's ability to grow, increase its valuation, and ultimately pay back its debts, or see its stock price rise high enough for the conversion to be beneficial for both parties. It is a high-stakes maneuver for Bollinger Innovations, balancing immediate funding needs with long-term capital structure management. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into company filings. Don't forget to check out our Discord community in the description below for more insights and discussions. Thanks for watching. See you next time.